Amish Munshi is now with us. Amish, as far as Reliance is concerned, what is your call? You think that it's a stock which is moving after years and that's why the re-rating may take some time?
No, definitely. I think if you look at even in the institutional ownership, we feel that probably it is under-owned as compared to benchmark. Last 6-7 years, definitely the company has not done much in terms of its market performance. But fundamentally, most of the capex behind them, new business is one part, which is the retail plus settling down, and slowly clarity as well as some cash flows emerging on the telecom side. So that's why. So fundamentally, we're quite bullish on the stock with the long-term perspective.
Right, but even despite the move today, it's still one of the most attractively valued stock in the Nifty pack, only on the basis of PE or earnings.
Yeah, so within the large cap space, if you see in terms of valuations and like we just discussed, capex behind them, cash flows starting to come in over next 2 to 3 years, kind of a thing. Definitely on a relative valuation basis, looks attractive.
Right. How would you look at Reliance from here on? What essentially do you think is the trigger? Is the capex behind that's the trigger, or growth coming in from telecom business that's the trigger?
No. So I think the first definitely will be the capex behind. It's a huge capex, right? And those capex now getting over and cash flow starting. I think to at least over next 1 or 2 years that will be. So in terms of overall moving the needle, will telecom become so significant to move the needle over next 2-3 years? Definitely, our answer is no.
Right, but in terms of telecom, can you just tell us? I was just looking at the ROC for the company, or rather capital employed to try and get the ROE. They have employed about 28-29% of their capital so far in the telecom business. And you think the street was very negative that even in April, SOPs would continue or subsidies would continue from Reliance, but that's not happened, and that comes in as a relief?
Yeah, so I think what we are seeing is definitely last 1.5 years has been quite negative for the telecom sector. New competition coming in. You see in first 6 months virtually free offer by the new entrant. I think those things are settling down. Coupled with that, over last couple of years, we have seen spectrum availability, spectrum pricing, and the works. So we feel that probably things are settling down finally in the industry. Number one, definitely consolidation seems to be number one at this point of time. And like most of the global markets, probably we will also end up with 4 or 5 major serious players, because it's a hugely capital intensive industry. So that's one. Secondly, I think the new entrant coming in, the pricing doesn't look to be so negative. So even if you look at other telecom companies and you look at their ARPU, right, average revenue per user is roughly 150-160 kind of a time frame. So the new tariffs which are announced by the company, I think that definitely apprehension to the market in terms of even when they start charging tariff, will it be so low that the other existing players get impact? That doesn't seem to be in place. And thirdly, even if you look at the sector like we just discussed in terms of spectrum auctions, that capex is behind that. And lastly, in terms of valuation, so when you look at this sector vis-a-vis even most of the other emerging market peers, and the future outlook, more importantly towards data. So we firmly believe that over next 5 to 10 years, within the telecom space, urban India will drive the data, and rural India will continue to drive the voice, and that seems to be likely the play out scenario for the industry. So on a blended basis, a consolidation, major capex behind, serious players settling down, and reasonable tariffs. And huge potential in terms of data as well as voice, both in urban and rural, looks attractive.
Right. So, you also think that it's a function of the global liquidity that one is seeing? With liquidity being so high, markets have done across the globe, very well. So such a big stock with such opportunities and changes coming in the business, and, buyers just run?
So definitely global liquidity is there. To just look at the data, November, December, you saw almost $2 billion plus, which was redeemed just from emerging markets ETF. If you see first 45-50 days of the current calendar year, almost $7 billion have flown in actually, and I'm just talking about emerging market ETFs and not individual countries and stock-specific action. So there is definitely global liquidity. I think slowly as the markets globally are settling down to post-Trump era, so to say, after he has 20th January taken over, I think some confidence is coming back to the markets, some allocations coming back to the emerging markets. And if you see most of the forecasts also, so while global developed markets are likely to do better in calendar 17 as compared to 16, but there is also much more confidence in the emerging markets, particularly the draggers such as the commodity producers like say Brazil or Russia or Argentina for that matter. So I think there is a positive outlook towards emerging markets in terms of the global context and where the valuations are. So if you look at emerging market index is roughly 11.5 times P multiple. So I think those valuations are attracting fresh flows from global investors. And I think the second shift will happen in calendar 17, both globally as well as probably, for the first time in India also, we're seeing that some reallocation between the asset class will happen from fixed income to equities.
Right. In terms of flows, do you think the fund flow would also change? So we have seen IT and pharma not performing that well. Telecom has done well. Now Reliance is doing well. Names like Power Grid, NTPC, which used to not get a lot of flows, have done well. So is the flow allocation also changing?
So what we feel is that definitely market is looking at reasonable valuation at this point of time. So to say, from a macro perspective, markets are not extremely cheap that you will expect, floodgates opening in terms of money coming in and buying the market across the board. But we feel that on a given day, and the kind of volatility we have seen in the markets on a day-to-day basis over the last 3-4 months, there are enough individual stocks which are becoming attractive for long-term investors, and that's why you're seeing that by and large there is no sectoral leadership which comes out from the market on a sustainable basis, but it continues to be individual stock or for a couple of days some sector specific either expectations or actual news.
Right. How would you look at Axis Bank and with the news flow around takeover? That's also a name which has outperformed the markets in the last few days.
I think slowly world, both globally as well as probably in India also, I think we are expecting a much more M&A action happening. I think it's a culmination of both last 5-6 years of liquidity, lower interest costs, and secondly, I think to an extent it's also representative of companies looking at growth, probably much more in an inorganic way. Because if you don't have the global economy growing at, firing on all cylinders at 4% plus, or our economy at 9% plus, we are seeing that. We've seen in the recent past some global, takeover bids which did not fructify in the consumer space also. So we feel that probably as a culmination of liquidity, availability globally as well as domestically, reasonable or very low interest rates, and not so strong growth, you will see a much more M&A action playing out because companies are looking at inorganic growth route as compared to their organic growth.
How would you look at Jet Airways? So the last few days, airline stocks have done well. Any view on these names?
Probably they are colored by some of the recent investments by very well-known global investor, but we avoid because that's one sector, one industry which has not shown on a sustainable basis fundamental high ROC, ROE, or even cash flows or profitability. And with oil prices at where they are, and we expect actually a much more northward movement than southward in terms of oil price, which itself is 45-50% of their overall costs. So we are not so gung-ho about airlines as a sector itself.
Right. What are the other top picks that you have?
So currently what we continue to like is definitely consumer non-discretionary, consumer discretionary, more particularly two-wheelers and passenger cars. Auto ancillaries, which has definitely much more pricing power in terms of their product profile and some intellectual property rights there. IT continues to look reasonably valued from a long-term perspective. So we feel that a lot of technological change, platform change, which impacted them over last 2 to 3 years. Slowly they are getting their things in place. So that looks good. And on the domestic infra side, we continue to like cement and cap goods.
Just in cement and cap goods, can you be a little specific?
So cement, we like top names, or whether it's Ultratech or you want to play it through Grasim or Shree Cement, and in cap goods we like a lot of MNC names, because probably they will play out with if the US economy is also likely to do well, much more infrastructure spend there. There is much more higher probability there while they are already exporting to their parent company, that actually can accelerate. Coupled with that, our view that the infrastructure spend will also accelerate. The lower interest rates of last year and a half actually will start positively impacting the debt leverage balance sheets of most of the infrastructure players. So that positive effect will also play out. And lastly, the government focus on infrastructure building. So I think if you put all these things into perspective, so while we accept that probably the private capex will be delayed for another 2 to 3 quarters at this point of time, but I think capital goods companies with MNC package, we're currently operating roughly at 55-60% capacity utilization. There is quite a lot of operating leverage available if the expectations play out in terms of much higher orders, both from domestic market as well as international markets.
Right. REC PFC would also be a part of capital goods play or more on NBFCs?
Yeah, so I think that will be more on the financial side, but we continue to like on the financial side two space. We are very clear about that for last 2.5 years, and we think it's a long way to go. One is definitely retail focused private sector banks, and secondly housing finance companies.
Right. In housing finance company, what do you like? Because there are various housing finance companies.
Yeah. So I think in terms of our preference, definitely the first preference continues to be, besides definitely HDFC is Group Finance, which is again a subsidiary. That's the place we like the most.
Right. So basically want to play on the low ticket housing, Group Finance?
Yeah. So I think affordable housing, low ticket size, you said, being in the right geography. And we have seen, the key really in any kind of finance business, like most of the other businesses also, is that how do you manage your risks and the capital which is available to you when probably some of the competition might find it a little tougher to grow because of the capital adequacy constraints.
Right. So one thing that has been working very well for these NBFCs or housing finance company has been that the cost of capital is continuously going down. You think that is now behind, and now it will reflect the growth rate that they deliver in their PAT numbers?
Yeah. So we believe that probably the over expectation of the market of the direction of Indian interest rates southward, I think is very quickly getting corrected. We've seen in terms of inflationary trends both globally as well as even locally in terms of WPI. So while CPI has been helped because of demonetization effect, bumper food grade expectations, and next year also with good pulse production. But we feel that probably as the interest rate differential between the US and India narrows, there leaves a lower legroom in terms of further reduction in interest rates. You've seen, in fact, the bank FD rates also are not falling further. Probably they are now stabilizing around 7% kind of a thing. And probably over next month and a half, we'll see that the kind of one-time liquidity which came into the banking system, particularly to the public sector banks, which is roughly 70% of our banking system, that will quickly move out, right? So people will find different investment avenues instead of keeping their money with, at 3.5-4% savings account. So I think that the interest rates in terms of falling seems to have bottomed out. In fact, what will be critical is two things. One is how the crude prices spell out. Up till now, OPEC seems to be working, and that's why you're seeing hovering around 55. If the global economy accelerates as expected in 17 as compared to 16, we might see the oil at $60-65, which will have impact on inflation, and that's why interest rates. And secondly, I think it will be also critical in terms of at least the early monsoon forecast for the current year, because that will also be critical.
Right. Thank you so much, Amish, for taking out time for us. Always good to get a perspective from you.